Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of these financial filings, which can sometimes feel like reading ancient scrolls. Today we're diving into Xponential Fitness's latest 10Q report. Get ready for a workout because their financial picture has some stretches and some gains, and we are going to decode all of it. This fitness franchisor is pumping iron to try to reduce expenses with an increasing amount from legal issues and debt. They have a bit of body dysmorphia, trying to look more than they really are with lots of PR, but we are here to look past that into the bone structure of the company. Before we get into the details, if you like cutting through corporate jargon, make sure you're subscribed and also join our Discord community, linked in the description below, to discuss these filings with other people. Xponential Fitness, or XPOF, filed their quarterly report, a 10Q, on May 9, 2025, for the period ending March 31, 25, for the period ending March 31 to 2025, for the period ending March 31. They've got about 34.9 million Class A shares and 13.7 million Class B shares floating around. Now let's get into the meat of it and check out those financial tables. First up, the balance sheet. Cash is looking healthier, with about $42.6 million, up from $32.7 million at the end of last year. Their accounts receivable also got a little bump up to $28.9 million from $25.9 million. Inventory is down a bit from $10 million to $8.3 million, so they must be getting better at selling those yoga mats. Goodwill stays the same and represents their brand value and acquisitions. But let's not forget about the other side of the ledger. Long-term debt is sitting pretty high at $351, $6 million, a bump up from $341.7 million at the end of 2024. Their accumulated deficit, which is their total historical losses, isn't a pretty picture. It's at a massive $703.8 million. So they may be able to pump revenue, but they will need to really fix their ship. Now let's head over to the income statement. Franchise revenue, the bread and butter, came in at $43.9 million, a slight rise from $41.8 million. Equipment sales, however, took a dip, going from $13.9 million to $11.1 million. Merchandise revenue similarly dropped, clocking in at $6.3 million. Looks like they aren't moving as many branded water bottles and yoga pants as they used to. Net loss attributable to Xponential Fitness comes in at $1.9 million versus $2.5 million from last year, which is not that bad. Earnings per share is never good, being negative, but it seems to be improving from $0.29 to $0.10. Jumping to the cash flow statement to see how things are in reality, which might be quite different from the rest of the report. Net loss is still in the negative, and it seems the increase in cash comes from debt. They increased their long-term debt to the tune of $10 million, so keep that in mind. Operating activities provided about $5.8 million, so they did see some revenue at least. Now some things regarding their statements of changes to stockholders' equity. Equity-based compensation decreased to a gain of $3.2 million. Net loss is $1.9 million. What's this? The redeemable convertible preferred stock stays the same in share amount, but valued at over $100 million. This is a key difference. Switching gears, let's look at some important notes from the filings. They got rid of the Stride brand in February of 2024. That means some things are missing compared to past reports. They adopted some changes to how they report segments, but they didn't affect much in terms of the results for this time period. Contingent consideration, where payments depend on how well something they bought performs, is at $8.6 million, down from $17.7 million. They had a lot higher hopes on the performance of their acquisitions than what they seem to be seeing now. For Q1 2024, sales, general and administrative expenses were $36.6 million versus $45.5 million in Q1 2025. Most of the expenses in Q1 2024 came from this category. They also are having to dish more out for the marketing fund itself, going from around $6.5 million to $9.3 million. So those royalties are defined timely being paid out. There is a loan to a shareholder for $17.3 million that is not going to be paid back anytime soon. This is the price of business sometimes. The net loss per share for share A is very good looking compared to last year. Let's look at future notes. There was a correction to the Q1 2024, but this is small peanuts compared to their total revenue, so it's unlikely to impact much. Their assessment is that the intangible assets related to CycleBar and BFT brands have higher risk than the other. It would be good to keep an eye on those two to make sure they are well managed. As we mentioned, they borrowed even more. They got $10 million in additional term loans, pushing the maturity date out to 2027, but with an exit fee. It seems like a strategy to buy themselves some more time. Keep this in mind when they mention the profit that they have, because when you look at the real picture, they are $609 million in debt and have a stockholder deficit. Xponential serves as a guarantor for $750K worth of loans. This could be some risk in case something happens with the loans and they are on the hook. Now for a management's discussion and analysis of financial condition and results of operations to break down what all of this means. A large portion of their revenue and thus operations depend on attracting the right type of qualified owners to run the different brands. They have a huge pipeline of studios to open, but they aren't opening them as fast as they want, and it's impacting growth. There are so many different circumstances, economic factors, delays in construction, shipping, etc. that they can't control. Growth outside the US is a goal they are targeting, but that revenue stream hasn't taken off to have a big impact yet. Net loss still has a 3%, which is an improvement compared to previous year. Jumping to the legal section, there were a lot of problems they are facing but not admitting. Their problems with their past franchise agreements were pretty high, ending in a $25 million settlement on April 22, 2025. Adding onto the fire is the fact that both the SEC and FTC are trying to investigate them. Their tax rate is all over the place at negative 22%. It is very confusing. The redeemable convertible preferred stock are held by a couple of people, very centralized. It's also likely the reason their net revenue wasn't so good. Now, looking at these results more broadly, Xponential Fitness is improving its profit margins, but legal risks and debt remain a concern. Their aggressive growth strategy, which relies heavily on franchising, makes them very vulnerable to any economic downturns, because if their franchisees get affected, that revenue goes down and they are forced to make concessions. They are facing legal headwinds, which has been a large detractor and expense that has taken up a lot of resources. If they can't improve their situation and focus on making profits instead of growing to impress investors, they may be looking at even higher debt. Alright, that's our breakdown of Xponential Fitness's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.